So if you look at the drop here on Tuesday, I was in the latter half of it, and you saw that on the execution videos on the YouTube channel. The next day, at Wednesday, we have a candlestick high here. Now watch. This, that is your SIBI. This is your sell side imbalance, buy side inefficiency. This big displacement, lower here, this up close candle and this up close candle, that makes all one singular bearish order block. It's not the last up close candle. When I taught it initially, I taught it that way because I knew everybody's going to come out there and start teaching courses with it. There are times where I will do this, and the rules for using the up close candle, the last one before the drop down, that definition will be in my book because it's in written format. That means everything after that will be just parroting the written works of me. The audio commentary, the rules, okay, I have slowly sprinkled the logic out because I'm competing with every plagiarist in the world right now that wants to put this into a book form. They all want to be able to say they had it in their book first. That's why I'm doing it here in my own voice on YouTube. And there's millions of you now have watched me talk about this and teach it. And I'm the only one out here demonstrating it properly. You might have a winning trade here and there, but you don't even know why your trade worked. Like, you don't even know why that order block worked or that inversion fair value gap did what it was supposed to do. You assumed that you could handle that ZX14 and you jumped on it and you took a trade. You just happened to live through it like I did in 2008. And I barely lived through it in 2009. You see the difference? So because of this displacement lower, we can't use this candlestick high here to that candlestick's low. We have to refer to the truest beginning point of the order block, which is this run up. Okay, something here came into the marketplace that was unbeknownst to me. I don't care. I'm not trading in the morning session. But I saw what it was doing. So I went in and I worked with the position of getting short inside of this daily range. The latter portion of it, the afternoon session, post 1:30 p.m. Eastern Standard Time. So we have to look at this candlestick here. So what three price points here on this candlestick are pertinent or useful? We're down into the volume imbalance. See that? And now what you'll do is you will look at this wick here, and you'll look at this wick here. Divide that in half on both of them. I'm not going to do it because I'm trying to get through this lecture. It's already longer than I want it to be. It's always like that, man. If I say it's going to be short, it's going to be a long one. But I love over delivering. The difference between this candlestick's low and that candlestick's low. Okay, you see that? What is that? That's your fair value gap. This is just a SIBI. This is a fair value gap. And this is why when I look at other people on YouTube and they'll say, look, here's a fair value gap. That's not a fair value gap. That's not a fair value gap. That's not a imbalance that I'm going to utilize. See, what you're thinking is, because you've listened to me with graduated explanations, because I'm giving a little bit like a slow leak, okay? I'm leaking out. I'm teaching, but I'm not giving you everything because you all out there see people trying to pretend that they know what I'm teaching or they have it figured out, and they're trying to make courses and now they're writing books on Amazon because it's very easy for someone to throw something together and Amazon spits it out there. Okay, I could have my books out there in 2 weeks, but I'm fighting with my producer, my publisher, about the way I want my covers to be because I only get one chance to do this. Once I've released the book for public, I want it my way. And they're wrestling with, costs are going to be, I don't care. I'm not doing it to make money. But see, that's not what they see. They want to make money with it. Okay. So we're kind of back and forth with it over that. So it'll be released when we finalize all that stuff. Because I want the covers to look exactly how I want them. And I'm getting a little bit of resistance because of them saying the cost and what I want to receive as a royalty for each book too. It's a little bit of a back and forth. And if you keep messing around, it's going to self-publish, and I'll get all the money. So if you look at the low here to that candlestick's high, that is your real fair value gap. Other folks on the internet may see this and say, okay, ICT says that the best portion of shorts are going to occur in the lower half of that, and we'll leave the upper half open. And that is true when you're trading and utilizing a fair value gap that is a SIBI, but that is not what's going on here. That's why I tell you all the time, there is no one trick pony explanation for a fair value gap. You have to understand other factors and other PD arrays. You want a fast track to selling books and courses and being mentors because it's easy, quick money. But when people realize that there's someone out there that's authored it, it's teaching it for free, you're losing subs, you're losing subscription costs and fees coming in a month. And then it's going to make you mad and you're going to hate me. And you're going to create sock puppet accounts. And you're going to troll me. And you're going to leave comments in my comment section that make me smile and make me make longer videos because I like doing it. That is not what we're seeing here. This is a change in the state of delivery right there, that opening price. In a perfect world, price would do this. It would trade up to that level there, maybe just a little bit above it, and then roll over and go lower. That's the perfect world. But if we're thinking about things algorithmically, and I'm teaching you how to use these PD arrays properly, not look for an imbalance that completely closes in, then I'm going to go long or short based on that. That is the worst approach to doing that. That's the worst. That's the lowest form of trading with imbalances. That's the lowest form. Why would you want to do that? You're a bottom feeder doing that. There's more likelihood that your trade's going to fail if you trade like that than if you use the logic I'm teaching, which is you don't want to see them fill in. You don't want to see them fill in. So if this is the change in the state of delivery, that means the price was offered going up. So this is buy side delivery. That means the movement of price is going up. Then you have this displacement lower that overtakes that candlestick's low. Your reference point goes right back to that opening price. That's the change in the state of delivery. If you look at this price right here, this is on a, well, let's just do it. And if I talk about it, it's one thing, but we're going to look at Tuesday's price action, September 3rd. And the price is being annotated here on that opening candle. That price of that opening on this individual candlestick of Thursday, August 29th. So when we drop down to a lower time frame, this blue line is referencing this candlestick's opening price. Okay, let's watch. We'll drop down to an hourly chart. You already see it, don't you? You see it? What's going on there? It's leaving all this open. Light bulbs are coming on. Right? Let me go back to the daily chart. I want you to fully understand what I'm showing you. This candlestick, that opening price, we're drawing that out in the future. When price reaches this level, let me do it like this. I know when I change time frames, I get a lot of comments that they're saying, can you go slower when you talk about price and you change the time frames? I get lost. I get it. But that's the benefit of having a video. And it's also where you use the pause button and you compare what my chart's showing. I always make a point of putting my cursor on the individual candlestick. So that way, if you're really trying to learn this, you're going to be doing this same thing in your own charts. So this box here is highlighting. We'll do a different color so it stands out a little bit differently. We'll make an ugly yellow. ICT, that's my favorite color. Look, man, I don't like yellow, okay? So if we drop back down to a 60-minute chart, it's an hourly chart. Where are we at here? Why is that not going on to my, I think I have it set to only show on one time frame, isn't it? Yeah, I think so. All intervals. Now go back down to a 60-minute chart. There we go. Good grief. All right, so you can see what I was referring to here, where price was wicking into that. This is one time where my watermark is not working with me. So here's that opening price on that daily candlestick. That little movement to the downside, and then it rallied up. Then we had that rollover on Tuesday. Right at this moment here, look what price is doing. It's opening and trading right back up to it. It's leaving all of this open, and it's leaving all of this open. Now, think about this, young mentors, okay? You're running mentorships. You're trying to charge people money, teaching things you don't know how to use. You're going to look at this chart and say, all right, folks, I'm running a signal room. We're watching shorts. We're going to wait for price to get up into this area here. And right now you're probably getting pissed off because I'm talking about you. I don't know you by name. I know many of them in my mind I can think of right now. I'm not going to out you here. I'm telling you how to fix what you're doing wrong, because you're actually hurting people and you're defrauding people and you're teaching stuff that you don't know how to do. So because you're all here collecting and writing notes like scribes, I want you to learn how to do it right, because when I'm gone, people are going to be wanting to learn how to do this, and you're the first round of people learning directly as I'm teaching it. So you have an advantage. So doesn't it make sense to do it right and stop trying to be in a hurry to get some quick money? You can get a whole lifetime of money. I could be making $15 to $20 million every single month doing exactly what I'm doing right now, and I'm not even skipping a beat. I don't need that money. You do. So if you want a whole lifetime of educating with proper, respectable clientele that are going to say, you know what, we trust you because you're able to do it. That's what you want. You don't want people that think, wow, I have something I can teach in hindsight and I never have to do it in front of anybody or prove it. I'm telling all of you, if they're teaching smart money concepts or if they're teaching ICT stuff, unless they go out in front of the world and outline exactly how it should behave and everything, you don't even need to take a trade. Don't even do that. Tell us what the price is going to do. If they fall on their face, you just save your money. Okay? I promise you that's the easiest litmus test. You don't even need to see track records. You don't need to see trading logs. You don't need to see broker statements. Have them come out on a live stream right on YouTube. Everybody can see it. I have students that are doing it. Not all of them are teaching, obviously, but they can prove that they're doing it. The easiest way to determine whether you're going to waste your money is, can this person explain to me what price is going to do beforehand? And because I have always marketed that you're going to learn how to read price action, I cannot promise you that you're going to be profitable. Why? Because you're going to be like I was in 2008. I'm going to buy the fastest motorcycle and get out there and do stuff I'm not supposed to do. That's the reason why I teach the way I teach, folks. So all you foreigners that come at me all the time, oh, bro, you're a scammer. Fuck you. You have no idea what you're talking about. You're broke. I'm not. So this inefficiency right here, and this inefficiency, it should never be traded to. Why would you expect these two fair value gaps to ever be considered at all if it's inside of that bearish fair value gap and it's above the change in the state of delivery? That means it's going to do what? It's just going to go into a little bit. And then you want to see these things stay open, because that indicates that we're really heavy. We're real heavy. We don't need to see it go back up in there. But many of you that are trying to teach courses and mentorships or signal services, I've seen them. People send it to me. Here, look at this guy at Discord. He's trying to sell short here. He's trying to buy here. He's trying to do that. And I just respond with this: the blind leading the blind. You don't know what you're doing. Every little separation between three candles like this is not a fair value gap. It's not. This is further evidence to indicate that you have to have more intel about the other PD arrays, because no matter which one you start with, it could be the breaker block. It could be a propulsion block. It could be a, volume imbalance or fair value gap. You have to understand the other ones, even if it's a small little brief acknowledgement. Okay, I recognize it, but that's not what I'm going to trade on. You have to refer to it because it's part of the whole narrative of what price is doing. If I wanted to do it and it was possible, I could just say, here's the order block theory, and you never need to worry about any other candlestick but just this one. You can't. It's impossible to do that because you have to have other information from other facets of what price was doing. That's why you're all, you're angry at me because you think I'm hiding something from you when I've told you that you have to do these things to get the answers you're asking for. I know my limitation as a human being, as a teacher. I'm not going to reach to the levels of what you expect in answers for certain things because those questions are answered with your own experience. And that doesn't satisfy the people that are just 1 minute trainer, 5 minute trainer, teach it to me in 20 minutes or less. I don't want students like that. I want people that are going to be highly responsible and they are aware of what's being taught and shown to them because they can appreciate what's being shown to them because it's the truth. I can make this fraud. I can make this fluffed up and all about Lamborghinis and stuff, but I can't come out here and show you what I'm doing beforehand if that's all that it is. And that's what most of what you see on the internet right now is show everybody else my fancy, expensive stuff. And once that happens, the novelty wears off. Then what are you left with? The people want to see you explain it. Why should it work in their own hands? Because if you can't show the logic behind why it should do something, why should anybody send you money? But these inefficiencies they're not going to fill. They're not even going to trade back to you. Don't want them to. Now, because we have that, we can drop down to a 15-minute time frame. Man, it's a watermark. Take it off, ICT. I want you to get rid of it anyway. I'm trying to pirate your stuff. I know. Clowns. All right, so here's that opening price on the daily candlestick. And it's the change in the state of delivery. And you can see it wicking up into what we saw on that hourly chart. Now we're on a 15-minute time frame. It's trading into it here. And that defines that 15-minute, or sorry, hourly inefficiency, the downside. It's just a SIBI. That's not a fair value gap that you trade. Okay, it's just showing an inefficiency, but just because there's an inefficiency doesn't mean it needs to trade up into it. You want to see where you are in the lay of the land. Where is price at? Where is it likely to go? And how's it been delivered? These two inefficiencies in price, we don't want them to trade to them. We don't want to see price go up there. But watch what happens when it starts to break lower. After returning back to that blue line, which is the opening price, on the lower up close candle on the daily chart that frames the full bearish order block. This is what you end up doing with this information. Okay, this is all part of the price delivery continuum theory. Knowing what you're looking for from one higher time frame, and then using the information from that higher time frame, what should you expect to see in price? So it gives me the confidence. It gives me, I know what I'm looking for. I know what I'm going to trade off of. I know how I'm going to place my stop based on this information. Big, huge paradigm shift. Ready? You ready? I don't hear you. Come on, ICT, I'm screaming. So it trades up into the opening of that lowest up close candle that makes the bearish order block. This is the change in the state of delivery. The algorithm is going to refer back to that price. Here we are on a 15-minute time frame. Does it wick above it? Yes. Does it wick above it? Yes. Does it wick above it? Yes. How can you validate that that is really going to be an influential order block, ICT? Look at this lower time frame. What are the bodies doing? What are they doing? Are they just going through it? No. They're respecting it. Oh. So if I can see a time frame like this that's confirming it, that means this up close candle becomes a valid bearish order block. And then I can use its opening price right here. You're going to hear my stomach because I'm fasted. So it's already ground talking. We get that on that candlestick right there. We don't need a close below it. We don't need engulfing candles does this. We don't need an FU candle. All that stuff, that's all 20-year-olds working through a multi-level marketing scam ring, okay? Scammers Incorporated, okay? I got to resist myself because I could have a whole lot of fun with that, but I'm going to do it. But we have that opening price and we get it there. So that validates this as an order block. But now watch, when it does this, the next candle, what does it create? What's this? That's your first presentation. Oh, so it's not limited to 9:30 to 10 o'clock. Right. It's when you're using proper breakdown from a higher time frame down to a lower time frame, using the PD arrays in the proper context and its PD array matrix, where we're at in the lay of the land, that fair value gap, you can trade that right there. Where's your stop go? It's got to be above the order block. So your risk is entry. The lowest threshold entry is this candlestick's high. And that is, I got to move this down because it, or up rather. All right, the fair value gap is here. That candlestick's high is 19,183.25. So that's your entry minus one tick. So you want to get a fill. You want to make sure that you're going to get filled. That's it. Why? Because you have all these other things qualifying and confirming it. But your risk is the candlestick that is the bearish order block, this one here, because it should not go back above that. Especially now because we had this candlestick go above it and this candlestick goes above it. But prior to it validating that closing or that opening price, it didn't need to close above or below it. Let me say that one more time because I just gave a whole bunch of contradicting statements. This candlestick up close is your bearish order block. We don't know that yet until this candlestick crosses down below the opening price. It does not, on this candlestick, it does not need to close below the opening price of that to validate that as a bearish order block. What's good about this is we had this candlestick already trade above this up close candle, which is a potential, we don't know it yet, bearish order block. It wicked above its high there and it wicked above its high there. And then on this candlestick, we traded below that candlestick's opening. That validates that candlestick as a bearish order block. Any stop in this close proximity, you could use the opening of that candlestick right here. That right there, you could be entering, and you can add more into it into the fair value gap if it trades up into it. That's what I'm saying. Like you can use that as your entry mechanism. But for stop placement, you have to use the high of that candlestick plus one tick. And it never goes there. So that's your defined risk from this candlestick high minus one tick, that's your entry, to this candlestick plus one tick above its high. So that's your defined risk. And you can see multiple instances where you can get in and get short on that idea, that premise.